We are dependent on trade. Right at 50% of the soybeans produced in the United States are exported. China takes more of our soybeans than all other foreign customers combined. So they're a major part of our market.
China just canceled $1.1 billion worth of U.S. soybean orders without warning. Ships already sailing across the Pacific were forced to turn back, leaving American farmers with overflowing silos and no buyers. This wasn't a trade dispute, it was a precision strike. And while Washington was caught off guard, China was already 2 steps ahead. What happens next won't just hit farms. It could shake the entire U.S. economy. China didn't pick soybeans by accident. It knew exactly where to strike. The U.S. Farm Belt depends heavily on soybean exports, and China was once its biggest customer, buying over 30% of all U.S. soybean shipments. But in 2025, that number has dropped below 10%. The reason? Tariffs. After the U.S. hit China with $90 billion in new tariffs, Beijing responded by cutting deep into agriculture. According to the USDA's April 2025 report, U.S. corn exports to China have already fallen by 49% compared to last year. Soybeans are even worse. These crops are the lifeline for states like Iowa, Illinois, and Indiana. This isn't just lost trade, it's lost income, jobs, and political stability. Experts say China timed its move to hit right in peak export season, leaving farmers with no time to recover. Many analysts now warn China hit U.S. agriculture exactly where it hurts most: the profit margins. It wasn't just a canceled order, it was a global disruption in real time. On May 15, 2025, cargo ships loaded with U.S. soybeans were halfway across the Pacific when they were ordered to turn back. These weren't minor shipments, they carried over 2.4 million metric tons meant for Chinese ports. Trade analysts tracking vessel movement on marine traffic confirmed abrupt route reversals, causing chaos in port schedules and delivery chains. Major exporters like Cargill and ADM were blindsided, with hundreds of millions in projected revenue instantly wiped out. In the Midwest, silos began to overflow with unsold beans. That same day, soybean prices on the Chicago Board of Trade dropped by 3.7%, erasing over $500 million in market value. Farmers who had already taken out loans based on expected revenue were left scrambling. Truckers, grain handlers, and local businesses also took a hit. What looked like a trade cancellation on paper was actually a shockwave that moved through the entire U.S. agricultural economy in just hours. And Washington had no backup plan. While American farmers were watching their shipments turn around, China had already moved on to Brazil. Over the past 5 years, China quietly poured more than $8.2 billion into Brazil's grain infrastructure. New rail lines, upgraded port terminals, and dedicated export corridors built for one purpose: to bypass the United States. Between 2020 and 2024, Brazil's soybean exports to China surged by 48%, and by early 2025, over 64% of China's soybean imports were coming through Brazilian routes. These weren't just good deals, they were state-backed trade realignments. According to data from the World Bank and China's Ministry of Commerce, Beijing has been locking in exclusive contracts with Brazilian suppliers while offering financing and logistics support. The result? Brazil now supplies nearly 70% of China's total soybean demand. Without the tariffs, politics, or risks that come with the U.S., experts at HSBC called it a quiet trade realignment. But it's more than that. It's a strategic escape hatch, one that's leaving American agriculture in the dust. China didn't just react, it executed a precise and calculated plan. By canceling soybean orders during the March to June peak export window, Beijing ensured maximum financial damage. This is the time of year when U.S. farmers lock in their biggest contracts. Cutting off demand now meant there was no time to pivot. No time to find alternative buyers. China cited fungus and pesticide concerns as the reason for rejecting the shipments. But according to a May 2025 WTO inquiry, no such contamination was found. Trade analysts and agricultural economists call it a smokescreen, a strategic move dressed as a safety issue. The deeper goal? Shake confidence in U.S. exports, trigger supply chain instability, and remind Washington who's really in control of global demand. As one analyst at Rabobank put it, China didn't just pull out, it pulled the rug. And that rug included global buyers, shipping insurers, and even futures markets, all of which began pricing in political risk when doing business with American agriculture. The damage didn't stop at the farm. Once China pulled out, the ripple effects spread fast, hitting everything from crop loans to fuel production. According to Bank of America's May 2025 Agriculture Lending Review, lenders immediately tightened credit access for small and mid-sized farmers, citing export volatility. Many farmers had taken loans based on expected soybean revenue. Now they're struggling to meet payments. But it doesn't end there. Around 35% of U.S. corn goes into ethanol production. With corn exports down nearly 50%, ethanol supply chains have slowed, threatening fuel prices across the Midwest. Equipment manufacturers like John Deere reported a 6% drop in projected sales, and grain haulers across rail and trucking are facing order cuts. Even insurance premiums for agriculture shipments have climbed as brokers factor in new geopolitical risks. What looked like a farm problem is now becoming a logistics, energy, and finance crisis, and Washington still hasn't presented a clear response. While the U.S. reels from canceled contracts, China is quietly building a food supply chain that cuts America out completely. In just the first quarter of 2025, Beijing signed new grain deals with Russia, Argentina, Brazil, and Pakistan, securing over 70% of its grain and oilseed imports through partners outside the U.S. According to the IMF's April 2025 Commodity Outlook, these agreements include multi-year supply guarantees, infrastructure investment, and price stabilization terms that favor long-term resilience over market flexibility. For example, China's $4 billion agreement with Argentina includes not only soybeans and wheat but also port upgrades. A $3 billion pact with Russia now routes barley and corn straight to Chinese terminals through belt and road-linked rail lines. Meanwhile, China offloaded 1.2 million tons of U.S. corn from its reserves, blaming price instability, signaling a shift away from American crops as a core reserve asset. Experts call it what it is: decoupling in motion. China isn't just diversifying, it's replacing. In the heart of the U.S. Farm Belt, frustration is turning into political fire. States like Iowa, Illinois, and Indiana, which helped put Trump in the White House, are now seeing support slip as farmers face financial ruin. In 2020, Trump won Iowa by over 8 points, but according to the latest May 2025 Real Clear Politics poll, that margin has flipped to a 3-point deficit, driven largely by collapsing confidence in rural areas that depend on agricultural exports. Farmers who once backed tariffs now say the price has become unbearable. Many farmers feel abandoned by Washington, saying they trusted policymakers to protect them, but now they're bearing the brunt of the trade fallout. Across Illinois and the Midwest, farmers are halting equipment upgrades, freezing hiring, and delaying seed and fertilizer purchases. The stress isn't just financial, it's emotional. Farm bankruptcies have quietly climbed, while suicide prevention hotlines in rural communities are reporting higher call volumes. Local agriculture supply stores are seeing their worst seasonal sales in over a decade, and trucking companies that rely on crop transport are reducing routes. Even swing states like Wisconsin, Michigan, and Pennsylvania are starting to feel the economic pinch, especially in rural districts. This isn't just about soybeans, it's about survival. And if the administration doesn't deliver a real trade solution soon, it could face a full-blown farm state revolt in the 2026 midterms. The United States once dominated global agriculture, supplying over 30% of the world's corn and ranking among the top 2 exporters of soybeans. But that dominance is fading fast. China's trade realignment with countries like Brazil, Russia, and Argentina is chipping away at America's position, not just in sales volume but in strategic influence. According to the International Grains Council, U.S. soybean market share is expected to fall below 24.7% in 2025, while Brazil climbs beyond 51%, a record high. This isn't just a bad trade season. It's a systemic shift, and the problem goes beyond soybeans and corn. China is actively reshaping the currency structure of global agriculture. More of its trade deals are being settled in yuan, not US dollars, weakening America's grip on international pricing power. In Latin America, China's Belt and Road investments are locking in loyalty. Countries like Argentina and Brazil have joined BRICS Plus, pushing for a multipolar trade world where U.S. leverage is diluted. Even America's closest allies are drifting. In 2024, Canada exported $30 billion in goods to China, with agriculture, canola, pork, and peas leading the way. Canadian farmers are now more dependent on China than ever before. If China stops buying, their economy takes a hit. If they keep buying, they follow Beijing's terms. As analysts recently warned, this isn't just a farm crisis, it's a global power shift in motion. If the U.S. fails to rebuild trust, protect its supply lines, and modernize trade policy, it risks losing much more than market share. It risks losing its role as the world's agricultural superpower, and once that title's gone, it doesn't come back easily. China's latest move wasn't just about soybeans, it was a warning shot in a larger economic power play. Subscribe now to stay ahead as we uncover what's really happening behind global trade, agriculture, and America's next big challenge.